My goal with this course is simple. I want to give you a systematic portfolio that you can actually run today, which will beat the market with less risk. Here's the general idea of what we're doing. We are just trading a basket of ETFs following some signals and math that are used in the professional space. And by doing this, we are going to get exposure to 8 different sources of returns that are available in the market, right? So the S&P 500 is one of them. It's the returns driven by equities. And then there's other ones that we'll have exposure to. And running this whole thing is only going to take 15 minutes per week or less. And since all traders love a beautiful equity line, I thought I would show you what the backtest results look like for this strategy. As you can see right here, if this is what my portfolio ended up looking like over a 15-year horizon, so be it. I will take that. And of course, this is what really matters, which is the statistics for this portfolio. Here is what we are building towards. If you started with $100,000 in this portfolio, you would have $1.2 million in this account after a 15-year time horizon. That is a 1,100% return on capital. And as a compound growth rate, which is typically how we compare different investment options, we have a 18.4% compound annual growth rate. You compare that to the long-term average of the market, which is 8 to 9%, and you are laughing. This is a serious compounding vehicle that you'll have access to. And even if you benchmark it against the last 10 years of the S&P 500, where it's done just astronomically well, we still see outperformance. The S&P did about 13.5%, and as you can see here, we're still beating that by 5% compounded annually. Now, from a risk perspective, there's 3 metrics on this that we are going to look at. The first 2 are the Sharpe ratio and the Sortino ratio. If you're unfamiliar with what these metrics tell you, they are basically the professional standard for how you measure the risk-adjusted return of a portfolio. And so what I recommend you do is just take those numbers and those words, plug them into ChatGPT, and just let it tell you what it means. It's going to do a much better job than I ever could explaining it to you. And so I think that's the best way to handle those numbers. Long story short, we are getting an incredible risk-adjusted return. For every amount of risk we are taking, the compensation that we're getting in our account is really, really good. Better than you're going to find anywhere else for free on the internet. And so then we'll talk about the last metric, which is the max drawdown. 20% max drawdown is extremely low for an 18% compound growth rate. Think about this. The S&P 500 does maybe 9% a year on average. And in 2000, it did a 60% drawdown. And even over the same time horizon that we measured this strategy for, the S&P 500 had a 33% drawdown. So think about it. 18% compound growth rate, 100K turns into 1.2 mil. Our risk-adjusted return is really strong, and our max drawdown is just 20%. If you could do this by investing in ETFs and take 15 minutes per week to manage the trades, I think it would be a pretty good trade of time for returns. And that's really what we're building here. It is a wealth compounding vehicle that you can use for the long run to take the money you earn and everywhere else, shovel it in here, and grow something meaningful for yourself. This course is structured into 6 modules, which will take you through everything from how to actually run this portfolio to understanding the 2 strategies that comprise the portfolio and give us this return. And then I'm going to wrap this all up by showing you what the first 30 to 90 days of running this portfolio will actually look like for you and what that 15 minutes of trading per week will actually look like.